To find good pairs to trade, we want to find pairs of companies that have economic links. It's common to find stocks that are in the same sector and country. It's also good to look for a less obvious but still meaningful connections. For instance, companies that trade internationally may be affected by trade decisions by their respective governments. For example, steel companies in the US and steel companies in China may be influenced by political decisions made in either or both countries. Two companies may be suppliers and customers within the same supply chain. For instance, a textile supplier sells to a clothing retailer. A decline in clothing sales may impact the retailer first, and then impact the textile supplier a bit later. Two similar companies may be trading in separate countries and time zones. For example, a pharmaceutical company in India may see its stock rise due to strong international demand for its medicines. A few hours later, a similar pharmaceutical company in Germany may also see its stock rise. Notice in the last two examples, we see a lag between when one stock moves and the other moves in the same direction. A time lag is a good scenario to look for in pairs trading. If we see stock A move upwards and expect stock B to move upwards later as well, then we can place a trade after stock A moves, but before stock B moves. After stock B moves as expected, we can close our positions. Once we found a pair of stocks based on economic links, we can check if those stocks are in fact good candidates for pair tradings. We check the pair by calculating the spread. If the spread appears constant over time, it's likely stationary. Recall that a series is stationary when its mean, varies, and covariance are stable over time. Let's add more detail to describe the relationship between a pair of stocks. Recall that some time series, such as stock prices, are integrated of order 1. By this, I mean that if we take the time difference of this time series, we can get a stationary series. When a series is stationary, it is also integrated of order 0. Another way to get a stationary process is to find some linear combination of a pair of stocks. For example, if stock X and stock Y have an economic link, then if we subtract one from the other, we may get a time series that is stationary. More generally, we multiply X by hedge ratio using regression, then we take Y minus the estimate of Y based on the hedge ratio and the value of X. The difference is the spread. If the spread is stationary, then it is integrated of order 0. Also, if the spread is stationary, then we say that the original series of X and Y are co-integrated. The hedge ratio is also called the coefficient of co-integration. Note that co-integration is not the same as correlation. Correlation is the covariance rescaled to range from -1 to +1. A strong positive correlation means that when stock A moves up, stock B moves up at the same time and vice versa. However, if the magnitude of movement in one stock is greater than the other, then they can still drift apart even though they are correlated. In other words, two correlated stocks may not be co-integrated. Co-integration means that over a range of days, the relative increase in A is matched by a relative increase in B. Let's imagine that we use $100 to buy stock A and $100 to buy stock B. Assuming these are co-integrated, the value of both positions would remain similar over time. So keep in mind that a pair of stocks may be correlated but not co-integrated. Similarly, a pair of stocks may be co-integrated but not correlated. For pairs trading, we want to find pairs of stocks that are co-integrated. The method for checking if two series are co-integrated is called the angle-Granger test. The angle-Granger test involves two steps that we saw previously. 1. Find the hedge ratio using regression. 2. Calculate the spread and test if the spread is stationary. If the spread is stationary, then the two series are co-integrated. To check if the spread is stationary, we use the Augmented Dickey-Fuller test. The Augmented Dickey-Fuller test outputs a p-value. If the p-value is small, say 0.05 or less, then we can assume that the spread is stationary. Therefore, we can assume that the two are co-integrated.